The Social Security Administration has done something in 2026 that they have never clearly communicated to the public, and it directly affects every senior in this country, depending on the decade they were born in. They have grouped beneficiaries and near retirees by birth year and applied a different set of rules, different payment structures, different eligibility thresholds, and different claiming consequences to each group. And starting in July 2026, those group-specific rules are being enforced in ways that are going to blindside millions of seniors who assumed the rules that applied to their neighbor, their sibling, or their spouse also applied to them. They do not. If you were born in the 1940s, the rules that govern your benefit right now are different from the rules governing someone born in the 1950s. If you were born in the 1950s, your claiming consequences, your Medicare interaction, and your survivor benefit options operate under a framework that does not apply to someone born in the 1960s. And if you were born in the 1960s, the July 2026 changes hit your group with a specific urgency that the older groups have already passed through. The SSA will not call you to explain which group you are in. They will not send a letter walking you through what the July rules mean for your specific birth decade. They update the policy, and they expect you to already know. Today, I'm going to make sure you know. Find your birth decade, stay through what applies to you, and by the end of this video, you will have a clear picture of exactly what the July 2026 rules mean for your situation and precisely what you need to do about it. Before we get into the groups, subscribe right now and turn on the bell. The July rules I am covering today are not the last change coming this year. The SSA has additional policy updates scheduled for the third and fourth quarters of 2026, and every one of them will be broken down on this channel by birth decade, by income level, and by claiming status, so that the information is actually usable rather than just technically available somewhere on a government website that nobody reads. The seniors subscribed here find out about these changes in time to prepare. The ones who are not subscribed find out when the change has already affected their check, their Medicare premium, or a claiming decision they can no longer reverse. Subscribe, turn on the bell, and let's get into your group right now. If you were born in the 1940s, you are between 76 and 86 years old. You have been receiving Social Security for years, possibly for more than a decade. And the assumption most people in this group carry is that there's nothing left to check, nothing left to adjust, and nothing the SSA could do at this point that would significantly change their monthly income. That assumption is wrong, and it is costing a meaningful number of people in this group real money every single month. The first thing everyone born in the 1940s needs to do before July is verify their current benefit type. Not their benefit amount, their benefit type. A significant and consistently undercounted number of widows and widowers in this age group are currently collecting their own retirement benefit when they would receive substantially more on their deceased spouse's record. The survivor benefit available to a widow or widower can be as high as 100% of what the deceased spouse was receiving at the time of death, and in cases where the deceased spouse delayed claiming and accumulated delayed retirement credits before passing, that survivor benefit can be considerably higher than anything the surviving spouse earned on their own record. The SSA does not automatically move you to the higher benefit. They pay what you applied for. If you lost a spouse and you applied for your own retirement benefit without specifically requesting a survivor benefit comparison, there is a real and documented chance that you have been leaving money on the table every single month since that application was processed. Call 1-800-772-1213 before July and ask them to pull both your retirement benefit figure and your survivor benefit figure side by side and tell you which one is higher. That single phone call has resulted in benefit increases of $300 for $100, even $600 per month for seniors in this group who had no idea the comparison had never been done. The second issue for people born in the 1940s involves Medicare Part B premiums and the IRMA surcharge. Medicare calculates your Part B premium based on your income from 2 years prior. If your income in 2024 was elevated due to a one-time event, the sale of a home, a large IRA distribution, a Roth conversion your financial advisor recommended, Medicare is currently charging you a surcharge based on that elevated income, even though that income no longer reflects your current financial situation. IRMAA surcharges range from an additional $70 per month to nearly $500 per month on top of your standard Part B premium. The appeal form is the SSA 44, and it exists specifically for situations where income has dropped due to a life-changing event. If your current Part B premium is above $185 per month, you need to know why, and you need to know whether the SSA 44 applies to your situation before July, when the next premium recalculation cycle begins. If you were born in the 1950s, you're between 66 and 75 years old, and this is the group that July 2026 hits with the most variation because no two birth years within this decade operate under exactly the same rules. Your full retirement age is not 66, and it is not 67. It is somewhere in between, and the exact month matters more than most people in this group understand. If you were born in 1955, your full retirement age is 66 and 2 months. Born in 1956 is 66 and 4 months. Born in 1957 is 66 and 6 months. Born in 1958, it is 66 and 8 months. Born in 1959 is 66 and 10 months. That is your number, not a round number, not an approximation. The specific month and year when your full retirement age occurred determines the exact percentage reduction applied if you claimed early and determines the exact delayed retirement credits you accumulated if you waited. For people born in the 1950s who claimed at 62, the permanent reduction to your benefit ranges from approximately 25% to nearly 30%, depending on your specific birth year, and the gap between your claiming age and your precise full retirement age. On a benefit of $2,200 per month, the difference between a 25% reduction and a 30% reduction is $110 per month. That is $1,320 per year. That is $26,400 over a 20-year retirement. The SSA calculated your reduction based on your exact birth month and your exact claiming date. If you have never verified that the calculation was done correctly, July is the moment to do it. Request a benefits calculation breakdown from SSA and confirm that the reduction percentage applied to your record matches what your birth year dictates under the formula that was in effect when you claimed. Errors in this calculation are not common, but they happen and they are correctable when caught. For people born in the 1950s who have not yet claimed, if you are past your full retirement age and still working or living off savings, every month you have delayed past your FRA has been adding 0.2% to your eventual benefit permanently. That compounds to approximately 8% per year. Between your full retirement age and age 70, the maximum accumulation ranges from 24% to 32% additional benefit per month, depending on your exact birth year. On a $2,000 base benefit, that is between $480 and $640 more every single month for the rest of your life. The delayed credits stop accruing the moment you turn 70. If you are in this group and approaching 70 without having filed, the July window is one of the last clean opportunities to file with your full accumulation of delayed credits intact before the calendar moves past your optimal claiming point. If you were born in 1960s, you are between 56 and 65 years old, and the July 2026 rules hit your group with a specific urgency that is different from the urgency facing the older groups. Your full retirement age is 67. Claiming at 62 reduces your benefit by 30% permanently. On a $2,000 monthly benefit, that is $600 less every single month for the rest of your life. Over a 20-year retirement, that is $144,000 in cumulative losses compared to waiting until 67. The SSA will process an early claim without walking you through this math. They will ask if you understand your benefit will be reduced. You will say yes. And that reduced amount becomes your permanent baseline for every COLA adjustment, every Medicare interaction, and every survivor benefit calculation that follows for the rest of your life. The reason July 2026 is specifically urgent for people born in the 1960s is that the leading edge of this group, those born in 1960 and 1961, is right now entering the window where early claiming decisions are being made and the consequences of those decisions are playing out in real time. If you're in this group and you are considering claiming before 67 because you need the income, because your health is a factor, or because someone told you that claiming early and investing the payments is a smart strategy, you need to run the full break-even analysis for your specific situation before you file. The break-even point, the age at which waiting to claim pays off more than claiming early, typically falls between 78 and 82, depending on your benefit amount and your investment assumptions. If your family history and current health suggest you are likely to live past that range, waiting is almost always the mathematically superior decision. If your situation suggests otherwise, early claiming may be right for you. But that decision needs to be made with the full numbers in front of you, not based on a general impression that getting money sooner is always better. Go to SSA.gov, open your My Social Security account, and use the benefit estimator to model your monthly amount at 62, at your full retirement age of 67, and at 70. Look at those three numbers side by side, and then run the break-even math. That exercise takes 20 minutes, and it is the most valuable 20 minutes anyone in this group can spend before July. There's also something in the July rules that applies to every birth decade equally, and it involves earnings record accuracy. The SSA has announced that July 2026 marks the beginning of a new earnings record reconciliation cycle, in which records that have not been verified or corrected within a certain time frame may be finalized without further opportunity for amendment. What that means in practical terms is that errors in your earnings record that have gone unaddressed are approaching a point where correcting them becomes significantly more difficult. An earnings record error, one incorrect year, one employer who submitted wrong payroll data, one period of self-employment that was never properly recorded, reduces your monthly benefit by approximately $100 per affected year. A senior with 3 years of incorrect earnings data who catches and corrects those errors before the July reconciliation cycle closes is protecting $300 per month in benefit income permanently. Log into SSA.gov right now. Open your Social Security statement and compare the earnings listed for every year against your own records, including W-2s, old tax returns, and pay stubs. If you find a discrepancy, file a request for correction of earnings record with supporting documentation before July. The process is straightforward, the correction is free, and the window to do it cleanly is closing. Here is exactly what each group needs to do before July. If you were born in the 1940s, call SSA and ask for a side-by-side comparison of your retirement benefit and your survivor benefit, and check whether an IRMA surcharge appeal using Form SSA 44 applies to your Medicare premium. If you were born in the 1950s, confirm your exact full retirement age down to the month. Verify that the reduction or delayed credit applied to your record was calculated correctly. And if you are approaching 70 without having claimed, file before your delayed credits stop accruing. If you were born in the 1960s, model your benefit at 62, 67, and 70 using the SSA estimator at ssa.gov. Run your break-even analysis before making any claiming decision, and understand that a 30% early claiming reduction is permanent and compounds through every future adjustment. And regardless of your birth decade, log into SSA.gov before July and verify your earnings record year by year while the correction window is still fully open. The SSA grouped you by birth year. Now you know what group you are in and exactly what July means for you. Subscribe, share this with someone you know who is in one of these groups, and I will see you in the next one.